Ladies and gentlemen, good morning, and welcome to the Kfin Technologies Limited Q1 FY2026 earnings conference call hosted by IIFL Capital Services Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touchtone telephone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Devesh Agarwal from IIFL Capital Services Limited for opening remarks. Thank you, and over to you.
Thank you, Ryan. Good morning, everyone, and welcome to the Q1 FY2026 earnings call of Kfin Technologies Limited. Today from the company, we have with us Mr. Srikanth Nadella, the MD and CEO, Mr. Vivek Mathur, CFO, and Mr. Amit Murarka, Head of Global Business Finance, M&A, and Investor Relations. I would now hand over the call to Srikanth for his opening remarks, which will be followed up by a Q&A session. Thank you, and over to you, Srikanth.
Thank you so very much, Devesh. Very good morning and a warm welcome to one and all. It gives me great pleasure for me to come back to you again with yet another stellar quarter for us. I will start with the qualitative commentary and we'll discuss the financials at the very end. We continue to be the country's largest registrar by a mile, be the only qualified RTA who straddles across both sides of the registry business. One of it is the investor solutions and services, which is mutual funds, alternatives, pensions, private retirement schemes, what have you. And on the issuer side, where we are the share transfer agent, for a vast majority of the corporates. It gives me great pleasure, to call out some few important standout milestones we've accomplished this quarter. I'll start with mutual fund business. To start with, we continue to outgrow and outperform the industry in terms of AUM growth, albeit by a small margin this quarter. We grew marginally ahead of the overall industry on the AUM and by the number of asset management company wins that we have secured this quarter. We have won 3 new mutual fund mandates out of 4 that have gone for a discussion and negotiation this quarter. So that's a 75% win rate, and it gives us a great deal of pride in terms of several marquee professionally run asset management companies continue to use Kfin to be their preferred partner. Our SIP inflows by market share continues to be ahead of our total market share. As I always maintain, I believe that in the medium to long term, it is the market share of the SIP, which is the surest indicator of the overall AUM. Given our overall AUM is roughly about 32.5 and SIP market share is about 39, I do hope, should this trend continue, we should continue to see a upward trajectory in terms of the overall market share gain that KFINTECH would see. We have had one of the new ANC capital mine that has just gone live with their first deploy. In fact, it is happening as we speak. And it is a matter of honor for us that marquee PMS, who has just ventured into mutual funds and have adopted our latest template, which is XaaS, which is to stand for Everything as a Service, which means that we not only just manage the core RTA operations, but we also take care of everything else. We provide service and solutions around marketing, content, full stack digital, including infrastructure, and also everything to do with the partner solutions as well. So that's on the mutual funds. I'll give a little bit of deep dive along the way on the second larger business and one of the other core business we have, issuer solutions. Again, we've had a spectacular quarter and indeed riding the wave of the overall expansion of the primary market in terms of IPOs and the number of entities that have gone public over the past 12 months. But we've been outperforming the industry by quite a distance there. We've improved our market share from about 48% about 18 months back now to close to 51% in terms of the Nifty listed companies by market cap. The total roster of the corporate clients has swelled up now closer to 9,000 clients. We are hopeful by end of the year we will cross 10,000 mark and be the largest registrar by a line. There are several IPO mandates that we have won, which are expected to hit the street into the coming quarter to two, which would obviously help us in terms of the run revenue as well as the historical IPO revenue that we will get for the issuer solutions into the Q2, Q3, Q4. As we all know, it is the Q2, 3, and 4, which are more impactful quarter for issuer solutions, given several corporate actions continue to trigger. This being the Q1 for most of the financial services, I'd like to believe that the number financial growth of around 15% is normal, and the trend tends to pick up into the subsequent quarters. What's even more heartening is our continual focus on market share expansion, new client wins. In the international space, we have won several new clients in this particular quarter. This gives us nearly 13 additional new clients which are yet to go live, and some of them are large. One of them is Maybank, and we have won several trustee to run contracts, which gives us access to not a singular client but to several of them who that particular trustee has under their clientship. We have about 5 in Malaysia, 2 in Singapore, 1 in Philippines, and several in Gift City, which are under transition and yet to go live. Yet another business which we are extremely optimistic into the coming years, as I believe that this is a pure play tech play and one that probably will have a higher margin, albeit business which was loss-making, which has just turned the corner now and has broken even, which is the national pension system. We've been outgrowing the industry by a factor of 2, and happy to inform you that in a very, very short period of time, we crossed the double-digit market share of 10% in the overall trans in the country, despite the fact that we do not operate in the government sector, which means that government plus non-government together on the total share of the trans that exists in the country, we just alone on the private mandates have crossed 10% plus as compared to the overall market. AIF, has been growing at a sharing pace. We continue to expand our market share from 34 to 37% at this point in time. We are now the most preferred alternatives player in the country, given the only one with the proprietary platforms integrated, both transfer agency, fund admin, full stack digital play, and full stack analytics platform as well. We continue to expand our solutions in this space, not just in India, in Gift City, as well as onto the rest of the world. Given we are a large public infrastructure utility player, security is always on the paramount interest and in the signature in terms of both the board and the management in terms of making sure that we are on top of it. We continue to expand our investments and both effort-wise as well as dollars to continue to drive our bid-side score, security score to now crossing 810 amongst the best in the industry. And we'll continue to, get that probably to be the best, in times to come. The volume transactions has been steadily on the rise. Now we process a little over 2.5 million on an average. On peak days, it touches 10 million transactions. And we expect these numbers to compound at about 20 to 25% into the coming few years. This quarter also saw an important milestone in terms of several new products and platforms that we have delivered to. I will also call out outside of the core businesses, happy to inform to you that we have launched our KRA business. And within a matter of few weeks, we signed up with, 5 marquee clients, and it's a very auspicious start for us, and which I'd like to believe will augur well in terms of the growth of this industry. Would like to also call out that our KRA solution is the only one which is onto the tokenization world, which is probably the first to introduce, and the very many applications that we expect to see in time to come, will be seen by the world and will definitely further the onboarding journey to be far more frictionless and far more cost effective, if I may. I will also like to call out and give you a little bit of update on the acquisition of Ascent Fund Services, which I have called out in the previous quarter. Very, very pleased with the overall progress we could make in just a matter of 2 months. We have secured all the necessary regulatory approvals in India, and even as Ascent Fund Services is securing its approval from some of the jurisdictions, as one would recollect, they are present in 18 different countries. and hence there are a few more jurisdictions and regulatory approvals that are ought to be sought and is in the works, and I'm quite hopeful that in the coming weeks or so or months, we will get through that, and then we will, get on with the integration. It also gives me great pleasure to continue to belabor the point in terms of the growth prospects of global fund admin solutions. The organization that we have acquired has shown tremendous growth even in this quarter and the previous one. They grew at about 35%. We believe that we have visibility into our faster growth, in that number as Kfin combined with Ascent will have greater potential to grow into the coming quarters once we get through the regulatory approvals. We have also completed, once we have launched the wealth platform about 2 quarters back, which I've called out, and we won about 5 mandates. Again, it gives me great pleasure to let you all know that we have now formally gone live on 2 large contracts on wealth, which gives us an inlet not just into the Indian wealth industry, but also into the global fund industry, wealth industry, sorry. That again has a great potential given the platform is developed is multi-currency, multi-geo, multi-asset, multilingual in fact. Given it is not as a regulatory driven a business as a pure play asset management, we expect a far, fungible and, a path which we can easily traverse into many different countries, around a quick time. With Ascent, we have already started taking these solutions to many of the geographies that they are part of, without necessarily having to wait for, any of the integration which has no bearing on this particular activity that we're trying to do. I'll quickly come back to the mutual funds. The 3 mandates that we have won, I'll call out. One is Abacus Asset Manager, one is Marcellus, both marquee professionally run entities, and very happy to also inform about the win of Pantomath. Our continued intent to grow the digital development, for our clientele across, whether it is Kfin service AMCs or otherwise, continues to gain traction. That is a testimonial of not just our domain skills, but also our, technological superiority in terms of creating big data solutions that are being leveraged across the industry, including by the regulator and the industry body, if I may. We are also obviously blessed to have several of the fastest growing AMCs to be with us. 6 out of the top 10, AMCs that are growing in our country, fastest growing are with KFINTECH. Clearly, this is, incredible performance, of our clients, of which, we're only passive recipient, but our solutions and services, I'd like to believe, contribute in a significant manner, for them to grow as well. In terms of the 880 corporates that we have added during Q1, that is, absolutely spectacular. We have never added that large a client in a single quarter. Of course, this consists of both unlisted and the listed, and that obviously has contributed to our overall market share to go up to 51. We are, hopeful, in terms of several large IPOs, including, iPro Asset Manager, Misho, Pine, so on and so forth, several others, to hit the street into the coming, months and quarters, which obviously will augur well for the overall issuer solutions revenue, so to speak. We have covered the international. In terms of the wealth, I also want to call out that we have clocked our first international wealth win in Philippines. If you recollect, we have announced a win of Sun Life asset management client, both the AMC and the trustee in Philippines about 2 quarters back, on the back of a solid delivery execution and purely based on the experience the client have seen and based on the credentials that they saw in terms of our Empower Wealth platform. We have won our maiden international, wealth deal in Philippines, as we look to expand this into your family office and the wealth outfits into many parts of the world, starting with Philippines, Malaysia, Singapore, and so on and so forth. In the case of GIFT City, we have a pretty large market share of nearly about 60%, and you add the Ascent market share of roughly about 12 to 15, we get to nearly about 3/4 of all the GIFT City funds that are operational, and we believe that we'll continue to, grow at a similar clip given the differentiator solutions that we're able to offer on top of our platform. The AUM for international alternatives and pensions, all of them, AUM and revenue, has been growing north of 30%. It is no different this quarter as well. We've grown nearly about 30% plus in this particular segment. We also have called out our intent to step away from a non-core business called Global Business Solutions, which was mortgage management. As we all know, this all stood out as a line of business which was not core to KFin. As we concentrate on driving our agenda and vision to be a global fund administrator, we did not want any distraction. So we have initiated, moving out of our mortgage management solutions nearly about 3 quarters back. And we have another probably, 1 or 2 quarters left in terms of the revenue that was dropped in the previous year no longer will be available now. And by which time we will completely exited, keeping our focus entirely on the asset and the wealth management solutions, not to get digressed into other businesses. So if not for that particular purposefully orchestrated degrowth in the global business solutions, we have crossed 30% plus growth in our younger, faster growing businesses. The overall industry performance is something that everyone's fully aware. I think India is mutual fund industry is on the verge of crossing $1 trillion. I expect that to happen most likely in the next 12 to 14 months. That growth still pales in shadow in terms of the overall potential that we have, with a series of initiatives that are being taken by the regulator, by the industry body, and several asset management companies, including the RTAs, in terms of providing the necessary solutions, products, and platforms to drive financialization to every nook and corner, provide solutions for quick onboarding, quick transacting, quick query resolution, so on and so forth. I believe that this juggernaut in terms of growth of 20% plus of the AUM can continue to happen for a foreseeable future, even as nearly 10 million odd fresh investors come to the industry every single year, and that number could easily be deciphered from the fact that is a similar number that gets added into the provident fund, wage roll year after year, and the number of individuals coming into the formal employment sector, most of whom are extremely intentful of investing into the mutual fund as a preferred asset class. And a mark-to-market gain is anyone's call, but baking into moderate gains this year, given we've had a spectacular rise, I'd like to believe that we continue to see potential to grow up north of 15%, in terms of the revenues in these businesses into this year as well. I will also spend a few minutes in terms of, some of the other initiatives, that are incidental ancillary into the mutual funds. One of that is the mutual fund, MF Central. MF Central continues to expand its growth. More than the growth, I want to call out the impact that this platform has for, many ecosystem partners. Investors, of course, are probably the most benefited to be able to secure such a solution where the entire industry comes together under a singular platform, provide the ease of doing business is absolutely unparalleled anywhere in the world. With that as a solution, many fintech companies in India have based their business, on the back of the APIs that we're able to, extend. Many of those have been helping the mutual fund investors to stay put, in the industry, for example, taking the loan against mutual funds as against simply redemption, so on and so forth. It helps the entire industry and the fintech ecosystem, and very happy to inform you, we have onboarded nearly 230 clients as of June, and that number, continues to expand, nearly 10% every single quarter. So on the mutual fund side, innovation continues to be, our absolutely, bellmark. We have also launched Iris as a platform, which is KFINTECH's gift, if I may, to the financial intermediation as a service class, which is the first of its kind, a multi-asset, multi-tenant, fully integrated CRM solution for the entire financial intermediary class. So it is not just for the mutual fund distributors. It is for the loan syndication. It is for insurance. It is for selling pensions. It is for selling CASA, bank accounts, credit cards, what have you, with a singular focus and view to enable and help individuals who choose to be financial, intermediate professionals make their livelihood in a far more effective manner. A single asset class or a single financial instrument, sale does not render itself to a very large, meaningful, career for many of financial intermediaries. So this platform basically solves for that. in terms of any financial intermediary can come onto this platform and for the same investor can upsell, cross-sell several different assets, which itself is one thing for the citizen. If you keep your hand as that of a citizen, where a single person can take care of many of your financial services needs and not just having to look at multiple of them. The release too of that particular platform is lined up for later this evening. I'm extremely hopeful and glad that it would be warmly embraced by the entire financial intermediary community. So products and platforms and innovation will be a large focus for KFINTECH. It is irrespective of its revenue potential. We believe that the things that we have to do to give back to the entire partner class, which is helping the industry to grow quite substantively. In terms of the RTA wins that we've had, I already called out the names. We are extremely excited in terms of the growth potential. These are marquee AIF, PMS player in the country, all of them. And given their pedigree, we expect rapid growth of their AUM in times to come as well. Just quickly call out a few things on the international side. As we all know, it is a composite solution of both RTA and fund administration. Overall client contracts this quarter, happy to announce that we have crossed the count of 100. Today, we roughly stand about 111. And the overall clients, quarter on quarter, even as they've been growing, very pleased to see the AUM growth, which was not the case in the past few years. Even the number of clients have increased. There were no mark-to-market gains, unlike in the case of India. We have seen that happening, and that is obviously one of the most important reasons why there has been 30% plus growth in revenue in this, notwithstanding the fact that close to about 11 contracts are yet to generate revenue in the context that they are under transition, and hence in times to come, the revenue for those, in addition to the AUM growth of the existing clients, will contribute to faster clip of growth in the overall international business. Now we started winning more clients in Singapore. As I said, we already had 2, and then now we have 2 more clients in Singapore that we'll be going live with. The traction in that geography, which is arguably one of the largest in Asia, will further be propelled as our integration with Ascent hopefully will conclude into the coming weeks and months. Outside of that, I think some of the LOIs that we have won, especially for a full service fund admin mandate for the Treasury Desk of Malaysia, is a very important milestone for us as we continue to expand our footprint in Malaysia. I think today we manage nearly 55% plus market of the market by the number of clients. In a matter of 5 years, I think that's a pretty good accomplishment. Of course, I continue to believe that it is the top 3 to top 5 AMCs which will make a material shift. And we are right now, talking to the larger the AMCs, and hopefully, we'll have some good news to share in the coming months. Lastly, I would like to just spend a minute on the national pension system, which I have already called out in terms of our growth. We have grown about 32% plus year on year on the subscriber base, with the largest service provider in this being nearly at 90%. And obviously a virtual monopoly till about a few years back. We take a good heart, and having broken even every brand addition from here on, I would directly add to the margin. And I'd like to believe that in the next 3 to 4 quarters, we should start seeing decent EBITDA contribution, even though if the scale is small, but we are expecting faster growth in the pensions. There's been a change of guard in the overall PFRD as an organization, and we are seeing a very, very strong and great intent to drive India to be a far greater pensionable society. A lot of interest and a lot of intent was asked of us as well in terms of what is that we can do to contribute in that regard. So we are in active discussions with several regulators in order to drive the overall market itself in that context. The order management system of Empower Hexagram is a revelation in terms of the number of clients we have been able to win. And it augurs well in the context that so far there haven't been too many Indian alternatives to large platforms like Bloomberg, for example, we have started to see green shoots in terms of our ability to displace large global order management systems. And as we scale it up and as we take it to global clients, we'd like to believe that this is a medium to long-term play, but I'd like to believe that there will come a time when we will be reasonably well positioned to take several of the global large platforms head on, even as we consolidate our position here in India. So with that, I will hand over the financial highlights to be provided by Mr. Mathur, and we'll take the questions after that.
Thanks, Shrikant. On the financials, the revenue has gone up year-on-year by 15.4%. Within that, the domestic mutual fund grew by 17.2%. Within this 17.2%, the fee-based revenue has gone up by 15.7%, and the VAS revenue has gone up by 51% year-on-year. The yield has come to 3.43 bips as compared to 3.6 bips last year, same quarter. And that's a combination of, the telescopic pricing impact and some volume-based discounts to some fast-growing AMCs that we have given. So we have been giving a guidance that the yield will come down year-on-year by 3.5% to 4% with a combination of telescopic pricing and, some selective discounts that we will give. But there is no yield shocks that we expect from KFINTECH. So we maintain that. In terms of issuer solutions, the growth has been 25.5% year-on-year. And as Shrikant mentioned, we have been adding IPO mandates and unlisted clients. Almost 800 clients have been added in the last quarter itself. If you look at international and other investor solutions, the growth other than GBS, which Shrikant clarified that that's a non-core business that we don't want to continue to grow, the growth is 29% year-on-year. And within that, international has gone up by about 36% year-on-year. AIF has gone up by 31%. NPS has gone up by about 33%. And, overall, we continue to remain buoyant about this segment in terms of growth trajectory. And, in terms of overall expenses, the growth has been about 16.9%, 16.6%. And that is mainly because of payroll costs going up. And, this is something where to support new clients, we have added some headcount. And as you know, in the Q1, the increment hits, while the impact of growth in business revenue will come in subsequent quarters. And, we have been investing in, technology, and cloud charges have marginally gone up. Other than that, if you look at the EBITDA margins, there is a healthy growth of 14.2%. We maintain a EBITDA margin of 41.5%, which is in the range of guidance that we gave of 40 to 45%. Typically, the first quarter is tepid because, the increase in payroll cost, and in the issuer solutions business, the corporate actions take place in Q2, Q3 rather than in Q1. And therefore, usually the Q1 is tepid, but it picks up from Q2 onwards. If you look at, PAT has gone up by 13.5% year-on-year and maintains a healthy margin of 28.2%. We have good amount of cash and cash equivalents, which is 750 crores at the end of June. One to pay out dividend, and another is to make the acquisition of Ascent. We are well equipped to continue to have surplus cash beyond the working capital, after paying out the dividend and the acquisition. The diluted EPS has gone up by 13% year-on-year. And, we believe that we'll continue to grow confidently, as Shrikant mentioned, both on the top line and bottom line, and we maintain our guidance. Thank you. We are happy to take questions now.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Hi, sir. Good morning. Thank you for the opportunity. First question on the mutual fund business. So, as you highlighted on the yields, just wanted to understand how much, so broadly from the end of last quarter, the yields are down around 5%, which is more or less, I mean, I think you normally guide around 3 to 4% for a year, and in a quarter we are seeing that. So, just wanted to understand that how much of this is because of telescopic pricing, how much because of the volume discounts that you gave to fast-growing clients, and this volume discounts that you have given, say, assuming that the mutual fund industry continues to see steady flows and growth remains, then would this likely be recurring at periodic intervals and would imply that we should expect maybe slightly more than 4% kind of a drop in yields compared to what you have guided earlier? So that would be my first question. Also, if I look at sequentially, the value-added services revenue growth also looks weaker quarter on quarter. I wanted to understand that because I thought that that would be relatively more, a stickier kind of a business. So while on year, I think it looks fairly strong, but quarter on quarter it is a bit weak. So wanted to know your thoughts on that. Thirdly, on the other topics, if you could throw some light on, there's been good control this time. So is this because we have cut down on discretionary expenses, and where should we see the numbers going forward? So these will be my questions. Thanks.
Sure. Thanks for the questions. So on the first question, I'll take it on terms of the basis points and the yield compression. We were at about 3.6, now down to about 3.43. You're right. I think it marks about close to 5% as against a typical year of 3 to 4%. I just want to call out that number is more an average. The contract renewal is entirely and solely dependent on the time of the signing of the contract itself. It is a coincidence that this year we've had more number of clients whose contracts came up for renewal. And for example, if you look into the next year and the year after, we just have one each. Right. And if you were to normalize it over a 3-year period, I'd like to believe that it will still come back to the 3 to 4% kind of a number. You may have a particular year where the number may look a little longer and of course bigger. And that particular, whatever the discounts, etc., whether it is because of the overall AUM growth or otherwise, they have all been baked into the Q1. We have no further renewals for the rest of the year, so to speak. In terms of the share of what was because of the expansion. So when we say volume, what you're really talking about is the AUM growth, not the volume of transactions. For example, in the previous year, many of us know that the mutual fund industry has grown up north of 30%, and our revenue also has grown up north of 30%. So it is a reasonable expectation and ask of our clients to partake in some of the gains that we have in terms of the growth that they're seeing. And that's what happens, when you see 30, 35, 40% plus kind of a growth, there would be a slight moderation of the basis points, and that gets, I guess, more than adequately compensated by the continual AUM growth into the subsequent quarters. So that's as far as the basis points is concerned. In terms of the value-added solutions, see, this is a pure tech revenue, and the tech revenue across business lines, not just mutual funds, but into the issue solutions, into the alternatives, into the wealth, so on and so forth. Typically, a large number of tech contracts get delivered in the last quarter. One, also because many clients have their budgets locked down to the end of 31st March, and they expect the contracts to be delivered as well. And that's a very typical phenomenon in industry. And typically, and hence we end up seeing a largish growth on the value-added solutions in the Q3 and Q4. And probably a flattish or a slight dip into the Q1 of this year. But as you rightly point out, if you see the year-on-year growth, the value-added solution stacks up at an impressive 50% plus. And I've called out back in the day, just around the time we went public, that in addition to, be dependent on the vagaries of the market and our clients' growth, we want to orchestrate several lines of business which is controllable at our end. And value-added solutions is one such thing. So for me, a 50% growth year on year is a very good indication in terms of where we head into the coming year. In conjunction with the fact that we have several new products and solutions that are going live and have gone live in the recent past, I'd expect many of them to convert into, hard pipeline and then into deals and, delivery into the coming, quarter, so to speak. On the cost, yes, we continue to, have a very, close grip on to the cost expansion. The revenue expansion in the core businesses, to an extent, come with a higher, cost expansion unless there is a continual transformation that is happening. To give you an example, a simple 100 rupee SIP probably will earn us 3 paise. But we would have spent easily more than the 3 paise in just creating the data records for that SIP for the next, 70 years, which is the norm in the industry. So until and unless we continue to invest significant sums and efforts in terms of ingeniously reducing the tech costs, which is largely the big tech players into, AWS and Microsoft and so on and so forth, the scale business will have an issue. And hence, we have a very large scale of data scientists who continue to look at it, and hence the non-discretionary spend has come down. But the non-discretionary spend vis-a-vis new products, new platforms, new solutions continue to expand. We believe that the future lies in innovation. Whoever could innovate faster, take a go-to-market solutions for our clients and for our partners and for our investors and the regulators will have a far superior edge in terms of new client wins and the growth that we've seen.
Right, sir. Helpful. Just one follow-up on the yield part. So we are right now in this quarter at 3.43. Assuming that there is no other renewals and, normal telescopic pricing will continue to play out, should we expect maybe another, say, 2 to 3% drop to the rest of the year? So if I were to think about 4Q, where should we end up with, is what I wanted to understand.
I don't expect any further drop on the basis points into the rest of the year. I think, on the telescopic pricing, we all know how it works, right? So there's once the AUM crosses a particular threshold, let's say we have an agreement that says that 50 to 75,000 crores, right? Only the incremental AUM that comes after the 75,000 crores may come with a smaller, basis points. And much of that, as I said, has already been baked into Q1. So I do not anticipate any further yield compression. I also want to call out another thing that has contributed to a dip, probably about 20% of the dip was because of a larger expansion of passives. If you saw, our overall AUM has grown, but the equity AUM in terms of market share was slightly below that of the market. That's largely because of a slow performance of the top 3 mutual fund houses in our country. And however, for us, there has been a substantial expansion of, non-equity asset classes, whether it is debt, whether it is, passives. And this particular trend is more the strategy of the fund house in terms of what they see as a time to stay invested in the market versus not to stay invested in the market. If you saw the math, I guess it clearly points to the fact that our clients have chosen to be more cautious and, stick to passives. But that can easily change, right? And depending upon the market sentiment and, their own, fund strategy, investment strategy. And as that happens, that will positively contribute to the yield. So I guess what I'm saying is I do not anticipate a reduction, but if there is a reversal in the investment strategy of our clients, there can actually be a slight positive surprise.
Understood, sir. Very clear. Thank you so much and all the best.
Thank you. The next question comes from the line of Karthik Chellappa from Indus Capital Advisors Limited. Please go ahead.
Yeah, thank you very much for the opportunity, team. Am I audible?
I think your audio is a bit low. Could you please use your handset and ask your question?
Sure. Hope this is better. So my first question is, assuming the normal yield declines at about 3 to 4%, and we are and we are assuming an overall AUM growth in the region of, let's say, 12 to 15%, would it be fair to assume that we should be able to hold our domestic mutual fund margins at these levels? Or what else do we need to happen for margins to kind of sustain in this current range?
Thank you, Karthik. Great question. One that I can assure you is always on the top of our minds. I think the good and bad part of, I guess, the way the industry is structured is a basis point, or a mark-to-market gains. It cuts both ways. You will have months, quarters, years when mark-to-market gains will add to both to your top line and to the bottom line, right? And likewise, it cuts both ways. When there is a mark-to-market dip and/or if there is a basis point reduction, it goes both from the top line and the bottom line. So that obviously is not the same if you were to extrapolate that into any other industry. For example, if you were to win a contract in manufacturing, or if you lose, there is a corresponding increase or decrease in the cost, and hence it does not, the 100% loss of revenue does not permeate into 100% loss of margin. But in our industry, it does. So the control in our hands are two. One, obviously, is to have a much more meaningful discussions and deliberations with our clients. And that is something that always happens when you're able to add significant value and not just do basic work. And that is something that I'm proud that as an organization we have been doing it. And that is clearly visible in terms of, I guess, where our basis, where our yield lies vis-a-vis others. The second is in terms of the cost. We continue to, as I said, work on basically have a target of near zero on non-discretionary spend. We will never get that far. I fully recognize it. But we have to look at mutual funds, given it is the largest book of business, probably the most complex and also the most voluminous and most tech-intensive of all the other businesses. We continue to work with our partners to continue to normalize and optimize the cost. And that, I like to believe, is probably the surest way to hang on to the margins, even if there were to be a marginal erosion of yield. And if you're seeing from our organization standpoint, I think every single quarter we have been able to maintain that margin in this particular line of business. And I will also call out our transformative initiative of FinEx, which is a complete replatforming of our core solution, which was in existence for the last 35 to 40 years. Whilst we have made incremental standout, changes into the overall platform to support the needs of the industry, the platform for the future is getting built. And I'm hopeful that into the next 3 to 4 quarters, on an incremental basis, it's not a zero-sum game that everything will happen on one day. We have already deployed several in a modular fashion. We'll continue to deploy several more into the coming quarters. As that happens, we should see a faster clip of cost optimization to happen, which will help us to hold on to the margin and probably even drive a margin expansion at that point in time.
Got it. Okay, thank you very much for the detailed explanation. My second and last question is on the issuer solutions. So we are seeing a very strong momentum on the corporate clients, which is welcoming. If I were to look at our investor portfolios, that growth has moderated this quarter, whereas in the last few quarters, we have been seeing that investor folios and corporate clients were growing more or less at the same rate. So anything to be read into this moderating growth rate, and what needs to happen for the folios to start accelerating?
Thank you, Karthik. See, I think, yes, there is a sequential, marginal decline. I think KFINTECH today manages near about 15 to 16 crore plus folios on the issuer solutions. What you saw is roughly about 12 to 13 lakh odd degrowth in the folio count into the Q1 of this year, sequentially compared to Q4. This again is a natural phenomenon. Nearly every year it repeats itself. What truly happens in the markets is, in Q3 and Q4 especially, there is a far more influx of retail investors. Part of it is, corporate action driven in terms of, securing the dividends and bonuses and what have you. And part of it is, to capitalize on the very large number of IPOs that have happened. People have made quick money and have also exited the market in real quick time. We have also seen, if you recollect, the month of April wasn't particularly a good month in terms of the capital markets. I think the sentiment started to turn mid-May onwards. And at this point in time, it looks reasonable, though the mark-to-market gain, I mean, in terms of Y on the index level is pretty much flat. That's what truly happens. There's basically a marginal flight of investors who have capitalized on the IPO and the dividends, and that's something that happens every single year into the Q1. As we move into Q2, Q3, Q4, I would call out to take a look at the trend of issuer solutions revenue in terms of how it expands into 2, 3, and 4 as compared to 1. This is normal. I wouldn't read too much into that. And the dip on a base of 16 crores, about 12 to 13 lakh folios, I'm sure is a very small, marginal number, which basically has not impacted much on the revenue. As you see, the revenue on issuer solutions has grown nearly about 24% year on year.
Excellent. That's all from my side. Wish the team all the very best for the remaining quarters. Thank you.
Thank you, Patrick.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Supratim from Ambit Capital. Please go ahead.
Hi. Thanks for the opportunity. Now, my first question is on the issuer solution business. So if we look at, the market share in mainboard IPOs, that was around 18% versus it being around 50-70% in the previous years. So just wanted to understand, has the competitive dynamics in this segment changed? Or, what are you seeing different, which has resulted in Kfin not being able to win the larger mandates? That was my first question. I have 2 more.
Yes, please.
Okay, so the second question, you do want me to go through all the 3 questions? Or?
No, let me answer that. And we can go to the second question. So here's the deal. So I think by count of IPOs, we've done over 40% in the industry. Yeah. And by value, it was 18%. It is a simple math in terms of, I guess, HDB financials having gone public, which was the largest IPO in the previous quarter, which was held by our competitor. And that skewed the overall, share by value. And this is not a reflection of the win, but this is a reflection of when the particular, company has gone public. Right? I mean, we have, for example, close to 175 odd IPO mandates, which have won over the last bunch of years, and they are yet to go live. So it is possible that in the next quarter, more mandates that Kfin has won have gone public rather than our competitors, at which time you may see a market share jumping up to 60, 70, 80 also. If I were to call out your attention in the previous year when we've done Bajaj, housing finance, or the year before LIC, our share of IPO by value actually stood at almost 85% in that particular quarter. So this is a timing, a discussion as against, the wins of that particular quarter. For example, if you have signed up a new IPO mandate in the previous quarter, it is, easily, 3 to 4 quarters away for that company to go public, right? So what you're now seeing in the previous quarter is actually the wins that, either of us have had over a long period of time, but which company decided to go public. So again, I wouldn't read too much into the value. Now dynamic has changed. As you could see, our market share has swelled by market cap, from 47 or 48 to close to 51%. We have now made a significant dent into even the SME IPOs. We have, I think in the previous quarter, been the largest in the SME IPOs, a business sector that, we have largely not been into. Now we have moved into the social stock exchange as well. So into the coming quarters, for example, many of our new clients such as iPro and Meesho and Pine Labs and, should any of them go public, you would see that 18% easily move up north of 50-60%.
Got it. That's very helpful, Srikanth. Now, on the KRA business, you outlined that you have 5 key clients. Could you highlight, which are these clients and how are you looking at embedding your KRA services with your MFRTA service? Are you making it available to all your MFRTA clients and slowly then 5 can become similar to the number of MFRTA clients? So wanted to understand, what is the development pipeline here? And currently, is the KRA revenue being built into the MFRTA revenue itself, or is it being shown separately in international and others?
A great question. No, so there's no revenue at this point in time, so none of it's being clocked into any business, right? We just went public, we just signed the contract. This is a separate entity altogether. It's a Kfin Services, and the revenue will be clocked into that different entity because the KRA business is not expected to remain in the same mutual fund business. In fact, Kfin as an RTA is one of the 5 clients of Kfin KRA, right? The other 4 are our clients as AMCs. The short answer to your question in terms of our go-to-market strategy is obviously to have every one of Kfin clients to be the KRA clients, which I'm confident will happen into the coming few months. Second, of course, is for everyone because this can easily be a multi-tenant model. This is not a zero-sum game, unlike in the case of mutual fund RTA. AMCs can have multiple KRAs onboarded, and in fact, that is at least a highly recommended strategy, at least from my standpoint, because it is always a business risk to have a single point failure, right? I mean, if you recollect about 2 years back, one of the KRA had a problem and which basically had impacted the mutual fund industry. So it's always a good solution to have multiple service providers, whether it is KRAs, whether it is payment gateways, payment aggregators, any of these entities at all, so that there is a failover. It's just like, I guess, a part generator as a failback mechanism that you have. So we expect to have nearly every mutual fund client to be our client in the KRA in time to come, even as within literally 15 days of launching, we managed to secure 5 mandates. And it is not just the mutual funds. We have to aggressively work with the brokers and the RIAs. Much of the new, investor onboarding actually happens, from the broker platforms, right? The distributor platforms, such as the Growers and Paytm Monies and, many of the large entities. So working with them is going to be very, very important. One, because technologically, I'd like to believe our solution is, far ahead and something that I'm confident will find favor with many of the large tech players who bring in far greater number of new investors into the industry as against traditional, RTA and AMC, I guess, equation, so to speak. So it is a solution that is not just for AMCs, but also for the entire, partner ecosystem who bring in the investors. And the revenue will be clocked in a separate entity. And as of now, there is no revenue, which you will start seeing into the next quarter onwards.
Got it. That's helpful. Now, moving to Ascent, thanks for the update that has been provided on the quarterly performance there. It seems like the revenue has grown by around 36%. But when I look at the EBITDA in January versus the April quarter, there hasn't been any movement. Is it a rounding error or, because against the 36% revenue growth, I don't see any movement in the EBITDA. So, just wanted to understand, what has happened there.
Vivek, would you want to take that?
Yeah, sure. See, they have still been investing. So while revenue will grow, they have been investing in terms of hiring senior people in the markets in which they are expanding. Like, recent hire was in US. And therefore, you won't see the immediate impact of increase in revenue in EBITDA margins. And as they start winning large contracts across these markets, you will see their EBITDA improvement over a period of time. And, the good thing for you to know is that the future payouts to the founders is linked to the achievement of EBITDA. And there are both positives and negatives. So if they don't achieve the target EBITDA, they won't get the multiples. So rest assured, the focus is in terms of growing EBITDA and growing a profitable business with Ascent.
Got it.
Thank you. I will also just add one thing. So this is the testimonial of any fast-growing, entity. I think as the entity is present in 18 countries, new geographies getting open. I think a lot of the revenue expansion is getting funneled back for faster growth. We have a path to profitability in terms of the overall numbers as we move into the year 3, year 4, year 5 as the deal is structured, which is basically more on an out model. You would see the EBITDA expansion happening. At this moment in time, it is to drive growth technologically, new country expansion, creation of the new sales channels, pipelines, and the technology. So to that extent, this is by design and as per plan.
Got it. And Srikanth, then, what kind of exit EBITDA margin can this business achieve? Because some of the listed peers do have EBITDA margins closer to 40%, whereas your MFRTA business and the issuer RTA businesses, they operate at more than 40, 50, 55% margins. So where can this business sit, once it achieves that scale?
So, see, this business is what does Ascent do, right? I mean, see, the global peers that you're referring to, if you kind of split between bank-based fund admin and the non-bank-based fund admin, we will fall into the category of the non-bank-based fund admin, which has several large, global fund admins like, your Citcos and SSNCs and FX Group and, IQ, EQ, several others. Now, they are into both public mandates and into private mandates. And I'm differentiating public mandates more as mutual funds and pensions and what have you. Private mandates more as alternate investment funds, hedge funds, digital currency funds, so on and so forth. The private side of it is far more profitable, book of business for many of these fund administrators beyond India, first and foremost. So because the public mandate funds work in a very different model, they do not have the RTA construct there. They work in the case of an omnibus model, which is very, very different. Second, the reason why we have partnered with Ascent and they have also partnered with us is that we are highly differentiated in our cost structures. We do not have the legacy challenges which many of these entities, possibly have, which is basically a technological proliferation that happens through large-scale acquisitions into multiple geographies and legacy systems. Whereas, we work on the cutting edge on the technological, innovation and proven engineering. Our cost base is substantively low. Those organizations are now trying to set up captives in India to optimize their cost. We, on the other hand, are India domiciled right from day one, broadly. So we believe that our margin profile for the entity in conversation, will be similar to that of Kfin and maybe even higher as we partner with them to take, for example, Empower to the rest of the world against using third-party software. We drive far more productivity through many of our, home-brewing solutions. We are able to take, for example, the LP portals, the GB portals, drive, data and analytics as solutions to the rest of the world, which are far more margin accretive, right? So simply put, I wouldn't compare Ascent with the global fund admins because those are, a lot more going to those particular entities, and not just the RTA. In fact, those entities also have custody as a business within that, possibly even by basic depository solutions within that. So we didn't have a like comparison of a pure play fund admin only solutions for private mandates, which I'd like to believe will be far more accurate than many of the global fund admins of today.
Thank you. Ladies and gentlemen, in the interest of time and fairness to others, we request you to restrict to one question per participant. We take the next question from the line of Vaibhav Sharma from Nuvama Wealth Management Limited. Please go ahead.
Hi. So I just wanted to know, so on the international business side, so there is a Q drop of 11%. So is there some one-off or something, and ex-global business, what is the growth that looks like? Also, on the Ascent side, have we added any new clients, and when are we expecting the consolidation to take place? And if there are any developments happening in the BlackRock Aladdin space?
Thank you. I'll take the last two questions and I'll request Vivek to answer the first one. In terms of Ascent's new client acquisition, there have been plentiful of new client acquisitions. They have started Saudi Arabia with one of the largest clients, and there is an expansion of nearly 60 plus funds in the previous quarter across multiple geographies. They have also signed a marquee contract with one of the largest banks in Singapore to be able to provide onboarding solutions, which is a large contract in the context of the overall revenue profile of the organization. The current run rate of revenue tracks to a 20 million plus revenue on an annualized basis. And should the current growth rate persist, we should expect the number to be much higher than that. Yes, so it is a combination of new client wins and certain AUM expansion of Ascent that has helped us. In terms of the integration, as I said, it is hard to give out a date and a time. Given this is an acquisition which involves multiple jurisdictions. So KFin ought to have gotten its approvals from our regulators, which is SEBI, PFRDA, and RBI. And I'm very glad to inform you that we have secured all those approvals. Ascent has more than 3 approvals to secure, given they are present in multiple jurisdictions, which they have also really secured for nearly 3/4 of those. So we have another 3 countries, I think, that are yet to accord the approval. They're in the process of diligencing it and certain questions being asked. And I'd like to believe it is a matter of time, that approvals will come through and integration, will happen. That said, that has not impeded our intent to work together. We've been working on a series of initiatives together on go-to-market, on technological integrations, so on and so forth, so that, the receipt of the approval, marks a milestone as against, a critical success factor to start that particular activity, if I may. In terms of the BlackRock Aladdin, as I said, in the previous quarter as well, it is a 2 to 3 quarters engagement in terms of integration of the solutions. We've had several promising meetings. We've working at tech-to-tech layer. We are in the process of integrating Aladdin with our back-end system, which is Empower. Again, I will call out that Aladdin is a front office order management system and a risk management system, at its heart. It needs to be integrated with our core middle office and back office, middle office being your settlement solutions, and the P&L, and then to the back office will get into the stage of NAV computation, what have you. The integration of these 2 platforms is the basic first step for us to take it to the market as a viable alternative to many of the global fund administrators. So I would expect only into mid part of Q3 that we would have reached out to the clients and the traction. We would have completed our go-to-market sales strategy, the commercials, the contracting structures, and possibly even having identified certain sales personnel in various important geographies. And it is strongly the potential that as Ascent's integration gets completed, those 18, 19 countries that they are part of, where Aladdin has a significant, market share, we would have already been, blessed, with the fact that several sales personnel already exist in the form of, Ascent having their personnel there on the ground. So in that context, I think, whilst we complete our technology, we're also working in the form of the commercials, the contracting, go-to-market, and the sales and the feet on the street, which may come from Ascent and from some Kfin.
I'll pick up the question on sequential decline of 11% quarter-on-quarter on the international end. Hello? Can you hear me?
Yes, I can hear you.
On 11% decline on international other industry solutions. The reduction is mainly because of GBS, and some part of it is because of NPS. NPS, as you know, is seasonal. And, typically Q4 is a tech season and people contribute because of the tech season in the last quarter. So about 50 lakhs is because of that. But, little more than 3 crores impact is because of GBS, where we are consciously declining the number of FTEs. And the whole focus is to move away from BPO kind of a business and start focusing on international global fund administration. So that's the reason that you see a decline. But, but if you consider, last year versus this year, except for GBS, all businesses have grown by more than 30%.
Thank you. We take the next question from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good morning, sir. Just 2 questions from my side. First, from the previous participant's question, if I look at the international and the domestic wealth or AIF businesses, excluding GBS and excluding pension, the growth rates which was tracking like 40-50. Hello?
Yes, please go ahead.
Sorry. If I just take cues from the previous participant's question, in terms of the international and other investor solutions, excluding GBS and pension also, the growth rates which are tracking, let's say 45-50% in the first, second, third quarter of last year on a YY basis now has come down to like 25-30% in the last 2 quarters. So in terms of incremental client onboarding or in terms of the pipeline, given the fact that, mark-to-market is also probably a little better than historical averages, how should one think of this business incrementally? And second, on Ascent's part, if I just look at third quarter metrics, compared to the first half or the last 2-3 quarters of the previous year also, it seems that the incremental number of clients added, incremental AUM growth quarter-on-quarter, all these metrics have kind of tapered down quite a lot. So if I just look at number of schemes, that's up like 5%, AUM is up 5% compared to, let's say, historical averages, which is far, far higher. So just wanted to get some sense of this new salespeople that they've onboarded. Should that kind of drive some amount of revival in the business momentum?
Yeah, so I'll pick up the question on, your question on, other than GBS, the businesses are growing, used to grow at 40-50%. That was more in AIF. But if you look at core international business, that has grown year on year at 36%. AIF, PWM, PMS has grown at 31%. NPS has grown at almost 33% year on year. So it's mainly the GBS impacts. Overall, we still believe 30-35% growth in international and other businesses, except GBS, will continue to behave like that. And with Ascent coming in, you will see the growth rate going up because their win rate and the growth in the funds under administration and the revenues for them is upwards of 35-40%. So you may see that the trajectory will continue to improve beyond 30% in future quarters.
I'll just add to this, Dipanjan. Historically, if you see the business, Q1, as we have always been saying that it's a quarter which is the leanest among all the 4 quarters and all. So across all the line of business, the activities start picking up as we move into the subsequent quarters and all. So given where we are in the market conditions and all, we believe that we are in a we have a very strong footing across all the 3 lines of the younger businesses which we are talking about. From the deal perspective, and I think whatever the guidance that we have given in terms of that 30-35%, that is something that we are fairly confident that we kind of be ahead of those guidance.
Thank you. We take the next question from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, hi, sir. Good morning. So just one question. So when we have highlighted that the yields in the domestic MS business is likely to remain stable for the remaining part of the year, so just wanted to understand the margins also in this business. So in this particular quarter, which has dropped to around 55%, unlike the previous quarters of around 59-60%. So would we be back to that similar levels of around 59-60% in the coming quarters, or is this the new normal of around 55%?
So I think it's a reasonably linear math, given that the pricing has been closed for the rest of the year. So the AUM expansion that will happen into the next 3 quarters, resulting in the revenue expansion month on month, quarter over quarter, obviously will expand the margin profile. So I do not anticipate that trajectory to differ. Again, I'll just call out, it is the exact same phenomenon we see every single year. Q1, we see 2 specific items, hit of inflation on April 1 because AUM remains largely similar. 31st March to 1st of April, there is a cost inflation that goes up. And the AUM, any discounts that are given in the beginning of the year, the AUM continues to grow at a clip faster than that of the discounts that have been accorded. Thereby, the margin expansion into that business will expand as well in the subsequent quarters.
Thank you. We take the next question from the line of Pranuj from JP Morgan. Please go ahead.
Yeah, thank you for the opportunity. I think, Shrikant, in the opening comments, you were mentioning about top 5 AMCs being onboarded on the fund administration platform. So just want to get a sense of what could be the ticket sizes of these contracts. Thank you.
See, on the fund admin, basically, we have multiple clients getting onboarded. So given this is an international platform, it is, we won contracts in Malaysia, in Thailand, in Singapore, and several, of course, in India. And within India, again, not just mutual funds, but also in insurance, right? For example, in insurance, I've been onboarded for Viva Insurance. In the case of mutual funds, it is JM and Cosmia. Internationally, several large trustees, including Aman Raya, trustee managers, so on and so forth, have been onboarded on that. The revenue, would be in two factors. I think, some of these are platform, solutions, and some of these are ongoing services. So ergo, the revenue will be split. Some will be more for a particular year, followed by a certain amount of AMC. And some of these are pure play services, just like the RTA contract, which means that month on month, for the service layer that we generate, we get a certain basis point. So the exact number I would request, Amit to discuss with you offline in terms of, having computed what is one-time episodical versus what is a run rate on that.
Thank you. Ladies and gentlemen, we take that as the last question and conclude the question and answer session. On behalf of IIFL Capital Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.